Before we dive in, a brief but important disclaimer. Made in Japan is an independent podcast co-hosted by Made in Japan and Ben Finzer, a portfolio manager at Fin Capital Management. Everything you hear on this show, including all opinions, analysis, and guest commentary, is provided solely for informational and educational purposes. Nothing on this podcast constitutes investment advice, a solicitation, or a recommendation to buy or sell any security or financial instrument. The views expressed by any host or guest are entirely their own and do not represent the positions, strategies, or views of Made in Japan or Fin Capital Management, its affiliates, its funds, or its investors. Investing carries risk, including the possible loss of principal. Past performance is not indicative of future results. Please consult a qualified financial advisor before making any investment decision. And with that, let's get into it.
Welcome to Made in Japan, where we explore the unique and often hidden world of investing, business, and the cultural landscapes of Japan. For our inaugural episode, we've invited Philip Partnow, co-founder and CEO of Chronus Capital Advisors. His colorful career has taken him from the US to Hong Kong, China, and finally to Japan. Along the way, he mastered both Mandarin and Japanese. Originally a corporate lawyer, Philip was later exposed to the world of M&A in Asia when he moved to UBS as an investment banker, a role that gave him the first taste of corporate activism in Japan. He has witnessed the development of Japanese shareholder activism firsthand, having worked closely with early pioneers of the industry like Yoshiaki Murakami of M&A Consulting and Seth Fischer of Oasis Management. Philip has so many fascinating experiences that every time we've had dinner, we've stayed until the owner had to politely kick us out. We thought he would be the perfect first guest to provide context on how the Japanese capital markets have developed over the last 2 decades and where it could go from here. Philip, thanks for joining us. You've been a lot of things, and you've been a part of the change in Japan over the last 2 decades. I can't quite do justice in describing you, so could you tell us a little bit about your background and how you ended up in Japan?
It's my pleasure. So in terms of my background, I started my career as a corporate lawyer with Sullivan and Cromwell in New York back in the 90s. And I joined Sullivan and Cromwell in part because I was interested in working in the capital markets in Asia. And at the time, they had offices in Hong Kong and Tokyo. So I thought that at some point I would have an opportunity to transfer out to Asia and just get involved with things that were happening out here. And that chance came in 1997 when Sullivan and Cromwell sent me to the Hong Kong office. At the time, Hong Kong was getting ready to return to Chinese rule, and it was booming. I moved to Hong Kong in April of 97. And then over the summer in 97, we had the Asian financial crisis and all the business dried up. At the same time, Tokyo was starting to really boom, because at the time, former Prime Minister Koizumi was trying to shake up the Japanese capital markets, and the Sullivan and Cromwell office in Tokyo had gotten very small, just 3 lawyers after the bubble burst. So my boss asked me if I wanted to move from Hong Kong to Tokyo, and there was nothing going on in Hong Kong, and there was a lot going on in Tokyo, so I said sure. And that's when I first came to Japan for work, was back in 97 as a corporate lawyer with Sullivan and Cromwell. I had always been interested in M&A and investment banking from the time I went to law school. And while I was in Tokyo, I had an opportunity to jump ship from Sullivan and Cromwell to UBS Investment Bank. As a junior lawyer, we always used to refer to that as going to the dark side. So I started working in M&A in Japan in 2000, and it was a very interesting time. Japan is a place because it changes very, very slowly for a long time. And then you can have these periods when change really starts to accelerate. And that was a time when Japanese companies were first getting interested in M&A. Traditionally, Japanese companies haven't really done mergers and acquisitions up until that time. So the market was growing very quickly. People were mostly looking outbound for deals. At the same time, there were foreigners that were trying to make acquisitions in Japan. So I worked in that capacity for several years with UBS as an M&A banker. And then in 2003, UBS decided it wanted to do a joint venture in China and asked me to take the lead in negotiating that JV. At the time, I spoke Chinese at a basic level, but they were interested in the fact that in addition to M&A, I had the legal background to be able to understand the regulatory aspects to setting up a joint venture in China. So I said, yes, I'll go do that. So from 2003 to 2007, I worked on first potential transaction, which didn't happen. Then found the transaction we ultimately did, which was the restructuring of Beijing Securities, which was a real landmark that went all the way up to the State Council to get approval. And I've moved to Hong Kong to lead the negotiation of that project. And then when we got the joint venture set up, I actually moved to Beijing to become part of the management team, get the joint venture off the ground. At the same time, kickstart the cross-border inbound and outbound China M&A advisory business for UBS. I was in Hong Kong and Beijing from 2003 to 2014. When I left UBS in 2014, I moved back to Tokyo. And that's the time when I started getting involved with the whole shareholder activism movement in Japan. I was friendly with Seth Fischer, who's the CIO and founder of Oasis, which is one of the OGs of Japanese activism. I'd moved back to Japan in 2014, and Seth called me up and said, "Hey, Philip, I hear you're back in Japan." I said, "Yeah." And he said, "I'm thinking about doing activism in Japan." And I said, "Seth, do you know how hard that is?" And he said, "Yeah, but what about the corporate governance code and the stewardship code?" And I was literally just back to Japan from China. I hadn't been following any of those developments. And when he sent them to me and I looked at it, I thought, wow, this is very significant, because there was an earlier wave of activism in the early 2000s with Murakami and Steel Partners, where people had mixed success. They had some successes, they had some failures. The deck was very much tilted in favor of management, and activism wasn't really accepted by the Japanese society or capital markets. So they used to refer to the activists as vulture funds. So that was the nuance. And so when an activist came in and took a position and was pushing for change in a company, if the company pushed back, Japanese society and a lot of the cross shareholders had the company's back. So the corporate governance code and the stewardship code, this is the Japanese government is now saying to corporate Japan, "Come on, guys, it's time. We have to change." And Seth was right to identify it. And I thought, wow, this is highly significant that we've got this impetus for change coming from the inside. And I said, sure, I'm happy to advise Oasis on starting their activist journey. And that's how I got involved with this more recent stage of activism in Japan.
And now you run Chronus Capital.
That's right. So my co-founder, Jun Suetomi, and I decided that we would start Chronus Capital because we really think that 10 years, well, I guess now it's 11 years on from the corporate governance code coming out, there have been a lot of developments in the market, and we think that the Japanese capital market is reaching a tipping point. I guess, first of all, we have the initial corporate governance code and stewardship code went through several iterations and updates and changes that slowly kind of tightened the ratchet little by little in terms of making the market more investor friendly. We've also had other regulatory action by METI. They published a couple of guidelines on improving the way M&A works in Japan. And then very significantly, about a year ago, the Tokyo Stock Exchange launched their low PBR initiative, where they said, we want to get Japanese companies to have a higher PBR. We don't want to see so many companies trading at a discount to 1x price book as we have right now. We also want management to show that they're conscious of the cost of capital and to start disclosing what they think their cost of capital is and looking at their businesses to see whether they're above or below their cost of capital in terms of the returns they're generating, and think about their balance sheet and how much cash they've got on the balance sheet. And in response to this, a lot of companies have really increased buyback and dividend activities. And we've even started to see some sign of companies delisting as a result of all of these regulatory changes. So that's, I guess, one kind of big change that's happened over the last 10, 11 years. Secondly, the amount of capital behind activism in Japan, the number of players and the number of companies that are subject to activist pressure has gone up by a lot. And then number three, the amount of PE capital out there looking to take advantage of these dynamics to try to privatize more Japanese companies is also quite enormous. So we think that this is a very special moment. I think of it as kind of like the 80s are coming to Japan. Now, I don't think it's going to be the Wild West hostile takeover boom that we saw in the US in the 1980s. I don't think Japan's going to go to quite that extreme a level. But I do think that all of those different changes and also just the advent of aging demographic changes in the C-suite in Japan that's causing a younger generation of management. All of these things are just making Japan very ripe for much more of an M&A kind of strategic oriented type of activism. I think activism, the early stages in 2015 through 2020 was mostly focused on the balance sheet. You've got too much cash, you have too many shares, you have an idle property, leasing it out, but it's not your core business. So let's dispose of those idle assets and return the cash to shareholders through dividends and buybacks. That was the main theme and continues to be an important part of the activist story even today. But now we're seeing much more business strategy, business portfolio optimization, privatization, consolidation, more of that kind of strategic and, from my point of view, higher value add engagement is starting to take off. And that's what Chronus wants to lean into. My background is an M&A banker. My co-founder's background is as an NPL, special situations investor. We think that personally, we're very well placed to try to engage with companies on these more strategic concepts. Of course, we'll talk to people about the balance sheet as well, but we focus a lot more on what's going on with the business and what dynamics are at play where potentially M&A could be an angle in our engagement with companies. And that's why we started Chronus.
I wanted to actually just rewind back to your early days as a corporate lawyer and an M&A advisor. One thing I've been curious about is you've worked across different cultural contexts, let's say, through China, Japan, the US. So I was wondering, what did you see there? How was it to see these different cultures coexisting in a business context?
Right. That was always one of the trickiest things on the one hand, but I always felt like that was part of my special sauce or my value add in the situation was to be able to understand the way people were thinking on both sides of that cultural divide and then try to help them communicate and work effectively together. So, for example, in the US, M&A has been a part of the corporate landscape for a long time. It's a very well understood business strategy. By the time I was working as a professional, most of the big US corporations had teams that were specialized in how to do M&A and how to use M&A as a tool for growing their company. So when you would interface with them, you were interfacing with people who were highly sophisticated, deeply experienced. Maybe they were former lawyers or investment bankers who had done the job that you were doing and had gone in-house. So it was very straightforward. And then the way a transaction would proceed or the way you would negotiate a deal, also very well trodden path, very well understood. And then when I came out to Asia, what I discovered was that the way people thought about M&A and their experience in doing it was much more limited. So in Japan, when I was first working as an M&A banker here, for starters, for a US company, usually you would go in and there'd be a very small group of people you were speaking with. There'd be the CFO or somebody from the finance department, and then there'd be a kind of a senior lawyer and maybe somebody from the business division that was interested in the deal because it's a highly confidential discussion, it's a strategic matter. And so you want to keep the circle of knowledge small. So we would show up to do a presentation to a Japanese corporate back in the early 2000s, and there would be an enormous team of people. There might be 15 or 20 people from many different parts of the company involved in the meeting. The Japanese bankers I was working with, they would always insist that we had to draft a 100-page presentation. So instead of a 20-page presentation that said, here's the idea, here's why we think it's available, here's what we think the valuation is, here's why we think it's good strategy for your company, here's what we think the synergies roughly are you interested? Japanese bankers said, no, you have to show them everything. Like you have to practically execute the transaction in advance and show them all the execution steps and put that all in the presentation, which to be frank, I thought was a tremendous waste of time. But on the other hand, they understood the way the client was thinking and what would be an effective presentation. So we would do all that. We would draft this very, very long document, and then we would show up to see the client. With a Western client, they would stop you and they would ask questions. They're interested in this, they're interested in that. But at the time, again, Japanese people, they're very polite. So they would very politely listen to the entire pitch, start to finish, as you were going through it. And then inevitably, there would be somebody, usually a junior person, sitting towards the back of the room who would ask you some incredibly detailed question. Like when you're drafting these presentations, they're like 100 pages long. And then you have to make some assumptions. If it's a dollar-based asset, you have to pick a yen dollar conversion rate to convert things to Japanese yen. And if you're going to draft that long presentation and translate it all into Japanese, you have to pick a cutoff date for the exchange rate. And of course, the exchange rate is the least important part of the presentation. It has nothing to do with whether this makes strategic or financial sense for the target, but there'd always be a guy in the back of the room who would say, oh, so on the footnote 3 on page 37, you said that the Japanese yen exchange rate was 152 to the dollar, but this morning it was 153 to the dollar. Could you explain to me why you picked 152? Of course, you want to say to the guy, that's a completely irrelevant question, but he's the client. So you would have to say, let me reconfirm and come back to you about that. Then as you went through the M&A advisory process with the client, it was kind of something that was similar. There was just a lot of different voices. Because Japanese companies tend to make decisions by consensus, there would just be a much longer and slower decision-making process going on within the company. And there would often be times when I'd be advising the client and they'd say, well, okay, with regard to these transaction issues, we want to do A, B, and C. And I would think about it and I'd say, we can certainly do A, B, and C, but I think it would be much more advantageous for your company if we did A plus, B minus, and C sharp. And they would go back and consider it internally. And then they would often come back to me and say, thank you very much for your suggestion, Philip. We understand why that would be a very good solution for us. But unfortunately, our company can't do that. And I never really understand exactly why they couldn't do that. But I often had that kind of experience. And a lot of times with Japanese companies, there would be situations where somebody senior who maybe wasn't that well informed about the project may have expressed an opinion, but because they were senior, that opinion had to be respected and reflected. There were also situations that I worked on where a Japanese company was thinking about selling or doing a joint venture of one of their divisions, where naturally you would have thought they should have sold the business, but they only did a joint venture. And then after painstaking hours spent with the team, finally understood that the reason it wasn't a sale was that the CEO of the subsidiary entered the company at the same time as the senior guy at the parent company who was leading the project. Since the senior guy at the subsidiary didn't want to get sold, the parent company felt it couldn't do it. It was an HR issue that was driving corporate strategy rather than the other way around. So there were just all these unique dimensions. Now, I'd say Japanese companies have come a long way in terms of their understanding of M&A, particularly the larger companies, and they're much more sophisticated. They have smaller focused teams. They have much better defined M&A strategy than they did at the time. But there's still those aspects of the decision making which have Japanese characteristics, which are part of how they make decisions, and that impacts the kind of transactions that they do and the way they pursue those transactions.
If you think back to 2014, is your view that M&A was still an untapped opportunity in Japan because of failed deals in the past that influenced executives? Was it mostly because cross-holdings created this intricate web of ownership or incentive issues? I mean, I'm sure it's a variety of factors, but if you were to diagnose the reason why a lot of these Japanese companies were not doing deals at that time, what were some of those reasons?
If you go to 2014 with the large cap companies, they had come a long way and had integrated M&A as a core part of their strategy. I'd say for the smaller cap companies, they were still somewhere along the sophistication curve, very similar to what it was like when I first came to Japan and was working as a corporate lawyer and an M&A banker. There are two different dimensions to this. I'd say the main focus of Japan M&A for the longest time, and probably continues to be the biggest source of large, sizable transactions, is outbound M&A. So Japanese companies saying, our market is shrinking, our population is shrinking, we want to grow our footprint overseas, we want to do acquisitions in fill in the blank, Europe, North America, Southeast Asia. China used to be on the menu, but because of the more recent developments, people are less interested in increasing their exposure in China. So it's basically everywhere but China. They're looking at large cap transactions. And for the smaller companies, they struggle. Like the sophistication to do a cross-border deal. A lot of the local management teams don't speak English and they're not that comfortable about their ability to navigate working with a subsidiary that's far away from the headquarters and where the business environment and the rules of the road are very different from what exists in Japan. So there's still that kind of hesitation on the small cap side. Also, I'd say for the small cap companies, they don't have a bunch of investment bankers turning up and saying, oh, there's this great European target or American target for you to be thinking about. So it's not as easy for them to find the opportunities. The big change that's been happening over the last 10 years is the dramatic increase in domestic M&A. And that's mainly a consolidation-driven play. Some of that has to do with the corporate governance code changes, and some of it, frankly, has to do with just Japan's demographics. So there's a real issue with succession-challenged companies. There are a lot of people out there right now targeting roll-ups of small, unlisted, family-controlled companies where the leader of the company is now in his 70s or 80s and doesn't have a natural successor within the family and is finally thinking about selling the company. Similarly, we see in the listed space, companies going from having the last generation running the company to the 75-year-old is passing off to the 40 or 50-year-old who's more open-minded, maybe more open-minded about delisting the company, maybe more open-minded about merging or acquiring a competitor. So there's just a lot of that domestic M&A that's really picking up. And that's a space for the smaller companies that's much more comfortable for them to play in, because they don't have to worry if they're consolidating somebody in their own space, then wow, that's a really easy business for them to understand. And the logic of a transaction is very easy to understand. Even if it's going into an adjacent area or a new business area, they just feel much more comfortable. They know the rules of the road. They can communicate very easily with the target company and its management. So that's been the real change that I've seen in the Japanese M&A market over the last 10 years. I think from an investor perspective and from a Chronus perspective, that's the aspect that's most interesting. Of course, we're always happy to talk to our investee companies about helping them grow overseas by doing M&A, but it's just much riskier for these small companies to go and acquire something halfway around the world. I would almost rather see them do the hard yards of trying to make organic growth in a new market work, as opposed to going in by acquisition. But in the domestic market, that there's a lot of opportunity. And why shouldn't these deep value, cashed up companies that have good businesses be expanding by playing that consolidation game and taking advantage of these successor challenge situations as they arise? And they are starting to get very serious about doing that.
One of our goals with this podcast is trying to understand some of those cultural differences. And I guess if you were advising a Western management team, whether it's a private equity partner or a strategic buyer looking at Japan, maybe showing up for the first time and meeting with a Japanese management team, what would be some of your advice for how to conduct themselves? And it might be interesting for us to hear any common mistakes to avoid or glaring issues that you've seen in some of these interactions.
I think, again, the people showing up in Japan and looking to do transactions here have also gotten much more sophisticated. I remember back in the early 2000s when there was the initial Ripplewood restructuring of LTCB and creation of Shinsei Bank. They made an enormous amount of money. And then everybody thought, this is great. We're going to go to Japan and we're going to all do a bunch of deals and we're going to make a bunch of money. Then people showed up and said, okay, we're only going to do an LBO. We can only do a control transaction. We can only do this, that, and the other thing. And at the time, there just wasn't a lot of that stuff going around. There was a lot of resistance to that. And there still remains to this day a strong preference by Japanese companies to remain listed. It's kind of an emotional, status-driven aspect of the corporate identity that goes beyond just the pure financial logic of whether it makes sense for them to remain listed. So at the time, I thought, it's great. You can show up and say you want to do all this stuff, but I don't think you're going to be able to do very much of it. And in the early days when they arrived, it was very difficult for them to get transactions done. Now there's been a big increase in the volume of those transactions. I would say, in terms of advice, number one, be patient. It often takes a lot more time to go from first making contact with the Japanese management team to getting to a point where, think of it like dating. You don't ask somebody to get married to you when you go on the first date. And when a private equity fund meets a Western company, a lot of it's about the numbers and what kind of price they can pay and what kind of price they're willing to pay, and also how they can do a good job of managing the company after they acquire it. But it can be a much shorter sales cycle, I suspect. But in Japan, it just takes time. You need to build up a relationship. You need to build up a level of trust with the management team and some of the core stakeholders. So I'd say that's number one, is be patient. Number two, look for situations where there's a potential catalyst already in the mix. So just showing up and saying, this company is trading at X, it should be worth 3X. We can do a deal together and all make a lot of money. Why don't we go do this? That rarely results in a successful transaction. So it's not just about the greed. I'm not saying that Japanese people are completely ungreedy. I think they're less greedy, perhaps, than similarly situated management teams in the US, but they are still people, of course, and respond to incentives. But that's not going to be the primary motive force for them. In general, there's a preference for the status quo. So unless there's some good reason to change the status quo, you're probably going to spend a long time waiting for that catalyst to arrive. And just thinking that you can seduce them into the idea of doing a transaction through charm or financial incentives rarely is enough to make the situation go. And then I'd say the third thing that probably matters more to the target company's management than it might in other markets. I mean, it's relevant in other markets, but it's even more relevant here, is showing how you can add value to them. how can your acquisition benefit the company itself and it's going to its next stage of growth? Maybe you've got a portfolio company in similar industry in the US or Europe, and you can show what a good job you've done on that one. Maybe you've got a portfolio company that is in the customer segment for this company, and you say, look, if I acquire you, then I'm going to be able to plug you together with new customers, showing your expertise at an operational level or showing how you can help them if they're very strong in Japan, but they've been struggling to grow in the US and Europe, showing them how you can help them find good distribution partners or other things that are necessary for them to succeed overseas. Those would be the kind of things, you might logically think, oh, I'm buying the company, so that's my risk if I can make it work or I can't make it work. All you should care about is how big a check I'm writing you. But that's not the way these target companies think. So really showing them that you can be a good steward for the company after the transaction based on your experience and your portfolio or your operations team. That's just incredibly, if it's valuable in the US, it's valuable times 5 or times 10 in Japan.
Maybe we can discuss a little bit of the outbound transactions, Japanese companies going out to acquire foreign companies. And I have to ask this carefully, but whenever a large cap Japanese company announces an acquisition abroad, my reaction is often, oh no. And it tends to be that a significant amount of companies end up overpaying for their acquisitions and leading to writing off their goodwill in a few years' time. So my question is, I'd love to hear your hypothesis on why this happens so often within Japanese firms, why this has been an issue, and how you think that's evolving.
Yeah, I think particularly for people who are not that experienced or sophisticated in doing M&A, the company decides, oh, this is something we have to do. And then there's a sense of urgency to get it done. Once the company as a whole has made that decision, the people who are tasked with implementing that decision feel a certain amount of pressure to do something. And then they often, I believe, wind up looking for transactions that are easily executable. So one thing, for example, I've seen a number of companies do is they buy businesses from PE. Now, there's nothing wrong with that per se. There are plenty of Western companies that do that too. But I do feel that it can often be the case with Japanese companies that when they go and buy a company from PE, it tends not to be the PE fund saying, okay, we're ready to sell the company, let's do an auction, and then the Japanese company making a disciplined bid and then either getting it or not getting it. I tend to see either a situation where once they get into the auction, they really feel like they must succeed and are willing to bid up the price in order to accomplish that. Or it'll be a situation where they go and approach the PE fund directly and say, we would like to buy this company from you, which is, again, conceptually not a problem. But I think the PE owners are savvy to leverage that desire on the part of the Japanese acquirer to extract an attractive price. So why is this the case? Why would this happen? I think there are several dimensions to it. One is the cost of capital in Japan is very, very low. And so particularly for bank debt, it's been very cheap for a very, very long time. Now, in theory, when you're valuing a target company, you should use the cost of capital of the target company in assessing its valuation. But I think Japanese companies tend to use their own cost of capital, and that allows them to justify paying a higher price than other buyers would pay. That's one aspect to it. The second, I'd say on the whole, I find the level of financial literacy amongst the senior management of Japanese companies to be much, much lower than it is of their international counterparts. And again, several reasons for this. Usually the people who are in the CEO and the CFO chair, they don't have MBAs. They work their way up through the company. A lot of Japanese companies promote the idea of generalist managers. So they will have circulated through production departments, R&D departments, planning departments, sales departments, and they will have been people who were successful in those different roles. And they may have been then sitting in the CFO or the CEO chair for a while, but they just don't have that capital markets background or capital markets discipline. In addition, they tend not to be very large shareholders in the company. They're more, we call them salaryman, the salaryman stewards of the company. I used to tell my colleagues overseas when they would ring me up with an M&A idea and say, hey, Phil, we've got this M&A idea. Can you bring it to the CEO of this Japanese company? And I'd say, why would I do that? CEO's not going to make any decisions about this. He's just going to turn around and ask all the middle management people. And once we went over their head to go direct to the CEO, they're going to be mad at us. So they're not going to try to help us with the transaction, and nothing's going to happen. And I used to say to them that the CEO of most Japanese, the large companies, they're more of a gardener than a hunter. They want to keep the garden in good shape, pull out any weeds, and then hand it over to the next gardener when their role is done without having messed the place up, as opposed to being a hunter that says, I need to aggressively lead this company and grow it. So I think that, again, plays into cost discipline in the M&A process. They're not really thinking like owners of the business. Now, there are exceptions to this. There are companies, of course, that are founder driven, where the founder still has a very substantial stake. And those companies tend to be much more sensitive to valuation for obvious reasons, because the owner is spending the family's money. They maybe own 30, 40% of the company, but that's the exception, not the rule. And in large cap Japan, there are really very few companies like that. So I'd say those are some of the key reasons why you see Japanese companies overpay.
So I guess from what I understood, there are some perverse incentives for a lot of these kind of management level executives when it comes to doing M&A, in the sense that some might not be interested in taking that high of a risk during their, say, 5-year tenure as CEO. And otherwise, maybe there may not be certain KPIs they track in place, for example, like a return on invested capital type framework for them to be able to track closely and compensate these CEOs. Or am I misunderstanding this?
No, you're spot on. So in terms of KPIs and performance, I mean, going beyond M&A, there's a broader topic about a lack of alignment between Japanese management teams and shareholders. And there's long been a push by foreign investors, and particularly by foreign activist community, to encourage greater stock ownership on the part of management teams, but also greater accountability. And it's funny, every Japanese company will publish a medium-term plan, and it's always a 3-year plan. And then every 3 years it gets updated. And then whenever they're updating the plan, they'll look back on the last 3-year plan and they'll say how they did. And then when you go in and talk to these companies and engage with them and you ask them, so what happens if you don't hit your targets? Does somebody's compensation get docked? Is there an aspect of the compensation that's linked to delivery of the medium-term plan? And everyone just kind of looks around at each other. It's a very uncomfortable question, because the answer is no, there's no accountability whatsoever. There's also no accountability to try to make the medium-term plan a stretch goal. So it's more like run the shop rather than change the shop kind of mentality amongst Japanese management teams. And you can even have the extraordinary situation where a shareholder will say, because if you look at compensation levels generally, Japanese executives make a lot less than their foreign counterparts. So if the US CEO is getting 10 and the European CEO is getting 5, then the Japanese CEO is making 2. And I'm not even talking millions. I'm just talking on a relative basis. It's just much, much lower. And there's a rule in Japan that if your individual compensation is more than 100 million yen a year, which used to sound like $1 million, but now sounds like it's $600,000. So if it's more than that per annum, your compensation gets individually disclosed. But if it's below that level, then you just have to disclose the aggregate compensation of the management team. In a lot of companies, Japanese CEOs want to stay just below that radar, so their individual compensation is not disclosed. So to start with, they're not that well compensated for what they do. And then a lot of their compensation is fixed compensation that doesn't have any performance component to it. So foreign investors come in and they don't say, let's swap out some of your fixed base for incentive and stock base. They will come in and say, let's keep your basic stuff the way it is because it's already too low. And then on top of that, let's give you some performance cash incentive, and let's give you some stock options or restricted stock. And they will make a shareholder proposal to that effect. And the company will oppose that proposal. So here's the shareholder coming in saying, Mr. CEO, we want to pay you more. And the management team saying, no, 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 no. We want shareholders to vote against that. It's quite extraordinary. But that's the situation right now. So it's that lack of alignment and lack of incentives that can explain a lot of the problems that we still see in corporate Japan.
What would you say are the best ways that shareholders can encourage companies to adopt more alignment between shareholders and executives. There are so many compensation consultants or proxy voting firms out there that have a number of opinions on what is best practice. If you were to think of the simplest structure that makes the most sense to deliver that outcome of alignment, what would you recommend to companies and to shareholders that are encouraging these companies to adopt those incentive plans?
Actually, my idea would involve going to the regulators and saying, why don't you get rid of this rule? Because in the US, you disclose the top 5 earners in the company individually. And that usually includes the CEO. But for example, in an investment bank with big trading activities, the top earner might actually be a star trader who works for the bank. So just make everybody individually disclose their compensation, irrespective of whether they're above or below 100 million yen. Because I believe that once Japanese CEOs realize that their compensation is going to be individually disclosed no matter what, they will naturally be more open to accepting higher levels of compensation. I'd say that's one point. The second point, in fairness to these management teams, they do operate within a society where it's not going to seem fair if what they're making is so much more than the people working on the shop floor. And they also have the scrutiny of their large Japanese shareholders that could include large financial institutions like insurance companies or banks. And they don't want to get sideways with those organizations because the person looking after the investment feels some kind of jealousy that the CEO of this investee company is making so much more. So there is a kind of let's say, a cultural context, which does mean there's some real difficulty in them accepting higher comp. Again, I think it's just a matter of being patient. It's not the sort of thing you can really shove down someone's throat unless you own 30-40% of the company. And then you can pretty much afford to do whatever you want. But it would be introducing them to compensation consultants, coming up with a lot of times in Japan, if you try to do something all at once, people feel like that's just too extreme. But if you say, oh, we're going to do a program where the first year we're going to do this, and the second year we're going to do that, and the third year we're going to do that, and we're going to slowly build it up, that's the kind of thing that the management team feels more comfortable with, and also will think that the Japanese shareholders will have an easier time accepting. So something that's staged in. And then it's really going to be tied to other governance improvements. So for example, does this company have a nomination and compensation committee? If they don't have one on their board, suggest that they get one. Well, the nomination and compensation committee, is it mostly staffed with internal people or is it mostly staffed by outside directors? Well, if it's mostly internal people, how about getting some outside directors on that? Oh, you've got some outside directors, but the chairman of that committee is the CEO. Oh, well, what if the CEO gives up the chairmanship of that committee and really lets an outside director take charge of that? Those kind of other incremental governance changes can ultimately lead to that change in the compensation system. But it can take time unless you have a very, very large stake.
Maybe shareholders also don't understand that incentives, if they don't exist on the financial side, they show up in other areas. I found companies where the CEO is a member of a country club and some of their key customers are also members of that country club. And if they were to raise prices dramatically, that would affect their relationship on the course. That creates its own incentive and keeping prices lower, for example. So yeah, I guess it could be interesting for you to maybe weigh in on any advice that you would give to activists or shareholders engaging with management teams that differ from M&A. Like specific examples, the one that you mentioned earlier that I thought was really interesting is starting with the middle management as opposed to the CEO. Do you think that that's relevant here as well? Or when it comes to incentive structures or engaging with management teams, is it best to start at the CEO level? Or any advice that you would have on the shareholder engagement side for meeting with management teams and encouraging change?
When you're engaging as a public market shareholder, your ability to access middle management is quite limited and may not be that productive in any event. I do think it can be useful to meet various directors of the company and also to meet the independent directors of a company and have an exchange of views with them about the situation the company finds itself in, what the company's business and strategic priorities should be. One can naturally touch on these kind of incentive issues in that context. I think that's the best approach to take. If in certain situations, you might even be able to propose the company consider a candidate of yours to join the board who's maybe somebody who thinks a little bit more along the lines of the way you think. Now, there are two potential ways to accomplish that. One is friendly, lovey-dovey, everyone's getting along so well. I know this person who would be a good candidate for you. Please meet them and consider. That's one approach. And then the other, of course, is the tougher situation where the engagement may not be going the way you want it, but you definitely want a spokesman on the board who thinks about minority investors, and you make a shareholder proposal and you try to get that person elected to the board, even though that person hasn't been accepted by the existing management team. So that would be the other tool in the toolkit, would be to think in terms of putting a director on the board. And I'd say the third one would be find a way to craft a shareholder proposal that may not prescriptively say this is exactly the compensation scheme that you should adopt, but put it on the proxy that the company should adopt a stock option plan, or the company should expand on its existing stock option plan, and let the shareholders vote. Even if that proposal doesn't pass if enough shareholders vote yes for it, management team will realize that shareholders care about it and will become much more willing to respond to the idea. So there are various tools, some of which are more constructivist, friendly, consensual, and some of them are a little bit more traditional, hard activist. There are various tools that you can use to try to promote that agenda or other agendas that you might have with the company.
I think this ties in nicely with the main topic for today, which is just activism in general in Japan. The starting point can be, why has activism been so difficult in Japan all these years? What were the hidden hurdles that really prevented a lot of these activist campaigns to not succeed?
So when I was working as an investment banker at UBS in Tokyo in the early 2000s, the first real wave of activism in Japan was starting to come online. And one of the early proponents of that was Murakami-san, who had been a METI government official. And he decided he was tired of trying to change Japan from the inside, and he was going to try to change Japan from the outside. So he raised a fund called M&A Consulting with a couple of partners, and they set out to invest in undervalued companies and try to push them to change and do things differently. This was very, very early days. This was 2001, 2002. At the time, one of the companies they invested in was an apparel company called Tokyo Style, which, by the way, is still kicking around to this day and is actually a target. It's called TSI now, and it's a target of AVIs. So some old chestnuts really stick around. But at the time, Tokyo Style had a reasonably okay performing apparel business, nothing too exciting, but it was profitable. And it had an undisclosed and unknown, but believed to be very large amount of real estate, and $1 billion portfolio of securities, and $1 billion valuation in the market. So this company was just obviously undervalued, and M&A Consulting had 5 to 10% stake. And they decided they were going to make a shareholder proposal that the company should liquidate its securities portfolio and do a massive buyback. They made this proposal, and then they came to one of my Japanese ex-colleagues and said, hey, would UBS be our advisor in this proxy fight? So the Japanese colleague came back to the office and said, hey, we have an opportunity to work with M&A Consulting on this proxy fight against Tokyo Style. Now, most of the Japanese coverage team recoiled at the thought of doing that, because most investment banks, we try to cozy up with corporate management teams. How can we be on the side of an aggressor? But I thought this was a super interesting transaction. And I thought if this can be successful, it's going to unlock a lot of other opportunities, M&A, block trades, whatnot for UBS. And I was able to persuade the senior management of UBS that we should take this mandate from Murakami. Now, I still consider that to be one of my best negotiations ever, was that internal negotiation. So we took on the advisory assignment, and we were working with Murakami, and we were supposedly advising him. Now, he's a very smart guy. He also doesn't really listen very much to other people. So I guess it would be charitable to say we were advising him. We were trying to advise him. It was challenging to advise him. But I personally learned a tremendous amount by working closely with him. And we were, of course, trying to add value in any way that we could. So in addition to trying to help understand better the actual valuation of Tokyo Style, proxy fight, let's try to go and round up support from shareholders to vote in favor of Murakami's proposal. In the aftermath of his announcement of his intention to do this, a bunch of foreign funds had come into the stock. Now, if you looked at the share register at the time, there was still a lot of what we call allegiant shareholders, banks and other corporations that did business with Tokyo Style owned about 30-40% of the company's stock. And that was just the obvious names. There might have been people further down, much smaller, who were there as well. But looking from the top shareholders, we could easily see 30-40% were in the hands of these Allegiant shareholders. So we knew that the hurdle to actually winning was going to be quite high. And in addition to M&A consulting stake, we were going to need to get the foreigners who had come into the stock to vote in favor of the proposal. So we drafted up a presentation. Here's how to vote in a Japanese AGM. And then we worked through our equities department to get access to these different foreign investors. And we went around and we saw people and we said, here's the proposal. Here's why we think it makes sense. We think you're a shareholder of this company. We think it makes sense for you. And then here's how you vote in a Japanese AGM. And what I was consistently told when we went around to see people was that at that time, they had never even tried to vote in a Japanese AGM. Now, I was astonished that these were people who were major investment funds. They have fiduciary duties. They're custodies of an enormous amount of capital on behalf of their clients, and they had very substantial investments in Japan. We said, how can that be? Why is that the right answer? And they would say, well, look, we get the document, and then we have 2 weeks to respond. And if we try to translate the document into English, send it back to fill in the blank, Boston, New York, London, wherever, get the investment committee to review it, give us a recommendation, and then put the vote in that 2 weeks time that we have, it's never going to happen. So we've never tried. We don't know how to do it. By implication, we're not about to try to do it just for this one case. That was naturally very discouraging. Now, it gets worse. So the way Japanese shareholder meetings work is there's a record date that gets set at the end of the fiscal year, but the actual date of the AGM was several months later. So most Japanese companies have their fiscal year end March 31st, and then they tend to do their shareholder meetings in late June. What happened was, as we got closer to the AGM, people thought the share price had run up in an expectation that Murakami was going to win. And people thought, well, this AGM, it's a risk. We don't know how it's going to turn out. So they sold, they exited. They had the voting right. So the people they sold to who came in post March 31st, but before June AGM, had no ability to vote. So even if these people were inclined to try to vote, they no longer had an economic interest. Originally, I had hoped that people would be a bit broad-minded about this and would have looked at it the same way that I did, that, okay, this one investment in Tokyo Style is a very small thing for any of these enormous funds. But if this proposal succeeds, the ripple effect across the rest of their portfolio in Japan should be enormous. So I was hoping they would look at it in sort of a broad perspective, but they took the smallest of small chunk approaches to the situation. On the other hand, management was very effective in getting the cross shareholders to come out and vote against. So yeah, we completely crashed and burned. We lost. So it was a great learning experience. Now, of course, fast forward to today, there's been so much focus on ESG that nobody can get away with having a big investment portfolio in Japan and not voting their shares. But I will say what we see is that there are exceptions, people who do vote in favor of shareholder proposals quite regularly. But a lot of the large investment funds are still very reluctant to vote in favor of shareholder proposals. And so you'll see some very large fund manager and you'll look, okay, in America, what percentage of shareholder proposals do they support? And maybe it'll be 30, 40%. And in Japan, it'll be like 7 or something ridiculously low. And what they'll say is, oh, we're afraid of losing access to management if we vote in favor of the shareholder proposal. Now, being on the ground and operating here, it sounds a little bit ridiculous to me, frankly. But that's the stance. Now, whether that stance is coming from the headquarters or coming from the local Japanese team, I'm not really sure. But I can say that it's well documented now that local Japanese fund managers, Nikko Asset Management, Daiwa Asset Management, are actually much more likely to support a shareholder proposal for an increased dividend or whatever than a lot of their foreign cohorts, even when you'd naturally expect it to be the opposite. I'd say, broadly speaking, it's that group of Allegiant shareholders, which has gotten smaller and smaller over time, but is still there. But back in the early days was very large, number one. Number two, at that time, the inability of foreign shareholders to vote, and right now, the sort of reluctance of foreign shareholders to vote their economic interest. And then the Japanese investment community is starting to wake up and exercise their rights more. But still, it's funny, you can even see a situation where you've got a bank or an insurance company that has a shareholding in a company, and then their asset management subsidiary has a shareholding in the company, and the two will vote differently. The asset management subsidiary will say, yes, we'll take the dividends. And then the parent will say, well, we have a commercial relationship with the company, so we'll vote against our economic interests there. So it's still complicated, but the playing field has shifted. One other major thing that's happened is that GPIF, which is the world's largest pension fund, has said, if you would like to manage money for me, and let's face it, what major asset manager would not want to manage money for GPIF, then you have to publicly disclose all of your voting on all of the proxies in every Japanese AGM. And so everybody does that now. So there's transparency. And then to GPIF, that means there's accountability. They can go back and say, well, wait a second, you said we don't need more dividends, but I'm a pension fund. I've got to take care of a lot of old people. Why do we not need more dividends? Do you really want to manage money for GPIF? So, I mean, they don't have to actually articulate it that clearly, but it puts a lot of pressure on people to be more economically rational in their decision making. And that in turn explains why the asset management subsidiaries of these larger financial institutions will often vote their economic interests, whereas the parent will kind of do whatever the target company wants.
That's incredibly interesting. So you've talked about how things have been changing recently. You can see this to increased participation of activist funds. It feels like there's a new lease of life in this whole strategy in Japan. What are some of the pivotal changes that may have gone unnoticed? Maybe you could share through your legal perspective or any kind of regulatory changes that you might have found interesting that really improved things.
For starters, the corporate governance code just coming out. Before that, it was very difficult just to get meetings with Japanese companies that you invested in. And a lot of Japanese companies didn't have an IR team. There was no IR function. Even at smaller companies where they don't have a separate IR team, now there's somebody, maybe the CIO or the CFO who's got a dual hat it and take care of meeting and talking with investors. At that time, people published their required disclosures, their annual reports, their interim reports, and that was it. They just sort of put it out, and it was a perfunctory exercise that was required by regulation. And frankly, not a lot of thought was given to it. So starting with that, the corporate governance code said, talk to your investors, understand what they're thinking, engage with them. It started becoming much, much easier to meet with companies and have a dialogue with them. So that was, I guess, the first one. And then over the years with the corporate governance code, they've slowly upped the ratchet on, you better have at least one independent director to, maybe a third of your board's got to be independent directors, and slowly increasing the number of independent directors on boards of Japanese companies. That hasn't completely addressed the issue. We still see boards that are dominated by insiders. Even when they have outside directors, a lot of times they're lawyers or academics or accountants who, when you meet with them, will say, I don't know anything about business. I'm a lawyer, so I focus on compliance. And you want to say, that's not what a director is about. But adding those independents into the mix, and then some of them actually having ideas and pushing management on things that are discussed at the board, I think that's been important. But the one that's had the biggest impact, which I referenced earlier, and I think it's only because it's building on all these other changes that have happened, is this Tokyo Stock Exchange initiative. Getting your price book above 1, publishing your cost of capital, understanding what your cost of capital is, using it to look at your businesses. This has been tremendous. There's still a lot more work to do. And by the way, I don't think the Tokyo Stock Exchange is done. I'm sure they're cooking up other new initiatives to further improve the governance of Japanese companies. When they published their last update about 9 months ago, on the first page, they said, we fully expect that these changes that we're putting forward are going to increase the cost of listing and will cause more Japanese companies to decide to delist. And we are fine with that. We are happy to have a market that's got a smaller number of higher quality companies. And I think for a stock exchange to say that, page 1 of a report they're giving the market is just extraordinary. And then if you talk to them about it more in depth, they say, look, what we care about is the total market capitalization of the companies listed on the Tokyo Stock Exchange. And all these little companies don't add up to a hill of beans. What we want are more large, well-organized, well-thought-out companies to be listed on the Tokyo Stock Exchange. Quality, not quantity, and size matters. And I think their leadership has been fantastic. There's still a lot of cheap companies in Japan, so it shows that not everyone got the memo, but you've just seen so many companies start moving off the back of that who were kind of sitting around not having any clear direction with regards to capital allocation. you've finally seen people take notice. Now, you might say, oh, well, one times price book and why price book? And isn't that just a dumb measure? And one times price book is such an undemanding concept in terms of valuation. Yes, that's true. But they wanted to come up with something that was simple and that was easy to understand. Baby steps. Put another way, if you got a bunch of companies trading at half to a third of book, you've got bigger problems to deal with than the finer points of calculating ROIC and whatnot. So let's get something that everybody can understand and organize around. Let's get that momentum started. And then we can, again, keep turning the ratchet and turning the ratchet. And I think it's just been tremendous. We had gotten through a couple of iterations of the corporates code and the stewardship code. I really believe that that was it. That was kind of all the help we were going to get from the government, from Japan Inc. And now we have the tools, and now the activist community was on their own. And then Tokyo Stock Exchange weighed in and just gave it another big shove forward. And it's just been extraordinary.
Thank you. I think it would be interesting for you to elaborate on that fear that institutional shareholders, especially foreigners, have in being branded an activist fund or supporting shareholder resolutions. And you said earlier that's a ridiculous assumption on the ground that they would lose access to management. Why is that the case? Because I still see a lot of institutional funds that are concerned to even bring up certain topics with management teams in fear that they'll lose access.
Look, I could understand why not everybody wants to be branded an activist, right? But just voting for a shareholder proposal does not make one an activist. And I'd say the counterpoint is plenty of activists still get access to companies. They're the ones actually stirring the pot, making the proposals, pushing companies to do things. So if the companies are still meeting with Oasis or Maruki-san at Strategic Capital, who co-founded M&A Consulting with Murakami, if those people can still get meetings, why would you think that somebody who just generally has a friendly dialogue and constructive dialogue with management, but every once in a while says, hey, did you think about capital allocation or your votes in favor of an increased dividend? Why would that suddenly put you in the black box? I don't see it. And I can certainly tell you from my own experience. Now, Chronus is still very small, so we're completely unthreatening and nobody knows who we are. But when we go and talk to management teams, we'll ask them lots of pointed questions. And we'll do it in a friendly way. And we're not publishing 100-page books on why they need to change X, Y, and Z. We're just having a quiet conversation with them. There was a company that they were talking about their manufacturing footprint where they make part of a product here in Japan and then they ship it overseas and then they make another part of it overseas, then they ship it back to Japan, where we said, why do you do it that way? And they said, oh, well, the part we do in Japan doesn't require very many people and the part we do overseas requires more people. So we do that at a place where the people is lower. Now, they have a big manufacturing platform in that overseas market. And I said, no, that wasn't my question. My question is, why do you bother doing the bit in Japan at all? Why don't you just move the entire process overseas instead of starts in Japan, then gets finished overseas and gets sent back to Japan for distribution here? Makes no sense. They gave me a non-answer, which tells me it's just always the way they've done things and they haven't really thought about changing it. And I get that. There's so many Japanese companies like that, but they didn't throw us out of the room. We had a good laugh about it. They're a lot less shy and a lot less easily offended than most people think. Now, there's a way of getting a difficult message across in a friendly way. They say, look, the company could be better if you did X, Y, and Z. And there's a way to do it that's very antagonistic. And I think unless you want to be the fire-breathing dragon, I wouldn't suggest going in and doing it in an antagonistic way. But there are plenty of easy ways to raise a topic. You can even just say, look, we did our analysis, and this is what it showed about your company, and we wanted to share it with you. They may listen to you or they may file it in the round folder, but they won't be upset that you brought it up.
I thought it would be really interesting to hear from you maybe some green flags and also some red flags for engagement for your fund as you're looking at potential candidates. What's the profile of a company that is ripe for activism and likely will engage with a consultivist? On the M&A front, you mentioned looking for specific catalysts that are already at play. Is that a similar approach that you would have on the activist front? What are some similarities and differences?
I'm not sure how much the rest of the activist community thinks about this, but for me as an M&A banker by background, if I went off and ran after every project where somebody said company A should buy company B without a clear catalyst as to why that would happen, I wouldn't have been able to stay in business for very long. So yes, absolutely. I look for those catalysts that are already in place in the situation before I lean into it. So what might be one of those catalysts. One would be a generational change in management. In general, if somebody's been running the company for 25 or 30 years and running it the same way all that time, I think the likelihood that we're going to show up and say, gee, here's a good idea, and they're going to say, oh, that's such a great idea. Why didn't I think about that over the last 30 years? I think the chance of that is pretty small. But when that person is handed off to the 50-year-old successor, who maybe already has a different way of thinking than that last generation, so that generational change within the management team, that would be one green flag or one thing that we look at. Another thing might be a big change in the share register. There's one company that we've just invested in where about a month ago, they announced that they were selling 20% of their shares in the market. Now, clearly, these are cross shareholders who have come to the company and said, we need to be more conscious of our cost of capital. And so we're trying to cut shares that we're holding, and we'd really like to cut the shares that we're holding in you. And so that company hired a securities firm, and they did a marketed offering of 20% of their share register. This company has always been a deep value play, but I stayed away, and I think other people stayed away in part because the share register was so unfriendly. Now, it doesn't have a perfect share register after this, but when a fifth of the shares just changed hands, the company is just much more exposed to the opinions of investors. So that kind of change can be another signal. Another signal might be some kind of big crisis or challenge at the company. So some of the situations I've gotten involved with in the past, the company had some kind of a scandal, turfed out the old management team because they were in charge of the place when that scandal happened. And so you had the management change, but also kind of a recognition or understanding at the company that something's got to change. Now, what they may be thinking about in terms of what that something is and what you may be thinking about in terms of what that something should be might be different. But there's already some disturbance on the surface of the pond, right? There are ripples on the pond already. It's something that's changing the dynamics there. So those would be the kind of things. There could be others, but those are the kind of things that I typically look at, or the arrival of one or more other activists. So we're not shy about going into a situation where there are other people already in there trying to make things happen. That's another catalyst for change. And our engagement might be a bit different. Our approach might be a bit different. But I think if you have multiple people engaging with the same company, even if it's not coordinated, they're going and having their conversations, we're going and having our conversations. I think it tends to be very additive. Maybe in some situations, even exponentially additive in terms of the impact it has on the company. So those are the sorts of things that we look for. I definitely want to see one of those catalysts before getting involved, because otherwise there's just so many situations where, yeah, the company is cheap and there's all these things they could do. And then you think, yeah, but what's the likelihood of something happening here? And then you look at it and for 10 years, nothing happens. And you think, oh, it's a good thing I didn't get involved in that because I would have been sitting around waiting.
When it comes to these catalysts, I think one important event that happened was when a company called Soft 99 tried to do a management buyout at a pretty ridiculous price, right? It was the low book value was probably something like 0.8, 0.9 times book. And the catalyst here was the activist fund, Activism, came in with a much, much higher offer to do a takeover. And this is probably the first time I can recall that an activist fund outbidded and succeeded in taking over the company from management. So can you tell us a little bit more about why this situation was a pivotal moment for Japanese activism?
Yeah, so Soft 99. I mean, this is a fascinating situation. And I actually have a fair bit of context and experience in this company. First of all, it's the kind of company that most value investors love. So Soft 99's original core business was car wax. And they went from making car wax to the rags that you use to clean the car and different cleaning products and then kitchen cleaning products. So they make a lot of these simple chemical products. And they have a very good brand and a very good market presence, very steady profitability, slow growing. And then they had a mountain of cash and other assets on their balance sheet. So they were typically trading at a very low book multiple, usually 0.3, 0.5 for the longest time. And I first went to meet them when I was advising Oasis back in 2015. We went and saw the company together. And the company is run by Tanaka Shacho. And Tanaka Shacho is part of the founding family. And the founding family controls around 31, 32% of the company through various different vehicles. So very much in control of the company and in control of the situation. Tanaka Shacho is relatively young. I think he's mid-50s right now. So when we saw him 10 years ago, he was mid-40s. But it was kind of clear from the discussion that he wasn't really in the mood to do things differently. And so after the first meeting we had with the company, we all just kind of looked at each other and said, yeah, this one looks hard, and moved on to better things. And not very much happened at the company. I called on them from time to time. When I started working with my next fund, NHGGP, we went and saw the company. And when Jun and I were setting up Chronus, we decided we would go back and request an IR call. And each time Tanaka-san actually showed up at these meetings. So even when we didn't have any shares at all, we were talking directly to the CEO and largest shareholder consistently. And he's a good operator, and he understands his business at an extremely granular level, where we asked him about some new products they were developing that were being sold through very niche channels. He knew the distribution, everything. So we thought, this company is really impressive, and Tanaka Shacho is impressive as an operator, but there's just no incentive. He just doesn't feel like doing anything. The company is the way it is because he likes it that way, and let's not waste our time. So Simplex, which is kind of a constructivist investor, had, I think, about a 12% stake for quite a period of time. And I guess eventually they got tired of hanging around, and they sold their shares to a company called Keeper. And I think Keeper came in, I don't know, 6 to 12 months ago. Now, Keeper is in kind of the same business as Soft 99, but they're a bigger company. And Keeper bought this stake from Simplex. And the last time I saw Tanaka Shacho was over the summer, mid to late July. And we asked him about Keeper's acquisition of the shares. Now, typically in a Japanese business community, when company A buys shares of company B, they've knocked on the door and they've gotten invited in. They've said, hey, we're thinking about buying some shares in your company. Would you be okay with that? And if the target company says, no, we're not okay with that, then they don't buy the shares. You think, oh, it's my money, I can go buy shares. But that is not done in a Japanese corporate context. So we saw Keeper as a large shareholder, and we asked Tanaka Shacho, so did they contact you first? Were they invited in? Was this your idea? He's like, no, they just bought it off a fund. And I didn't really think very much of it because, again, he controls 31% of the company. So this company is pretty much takeover proof. I guess he was worried about the potential that Keeper had bigger ambitions for owning more and more of the company. I believe that's what prompted him to launch this MBO. So prior to the transaction, the shares were trading at around 1,600 yen a share. And they had been sort of creeping up over the previous few years, but nothing very dramatic. And he launched his offer at 24.65. So yes, a big premium to what it was trading at. But I agree with you. The whole market just reacted with shock and even a bit of disgust that this was just such a lowball offer for this company. And people were upset about it, but he owns a third of it already. So you think, okay, well, this is a done deal. And there have been other situations where people have come in and tried to disrupt or get a price bump in underpriced deals before. Typically, there's situations where there's no large owner of the company and private equity has cut a deal. And then somebody, Murakami likes doing this, will come in and buy up a bunch of stock. Typically, we call it bumpitrage. We think they're just trying to get a bump in the price, just kind of threaten somebody to disrupt the deal and see if they'll increase the price and get it done on a slightly fairer terms. I had complicated reaction to this. First of all, I thought, gosh, I'm glad I stayed away from this thing like in 2015 and 2018, whatever, because I was right. Nothing did happen for a long time. But having been aware of Keepers coming in and then realizing that it wasn't at the request of management, I might have realized that something was more likely imminent. But again, my assumption was it doesn't change the situation dramatically. So I was obviously disappointed that we had missed out on this, but sometimes you're going to miss situations. So all fine and well. And then I thought, well, okay, this is a done deal. Even though it's a very underpriced offer, who's going to try to bumpitrage a situation where the CEO and the controlling family owns such a big stake in the company? So the deal got announced, I think, in early August. And then in mid-September, the Fissimo came out and offered 4,100 yen a share for the company. And yes, I was astonished, but obviously very pleased when I saw Fissimo doing this. So in Japan, the squeeze out rules require you to own 2/3 of a company if you want to really fully privatize it. So what you'll see most private equity deals and the deal that Tanaka-san's MBO had put together, in order to get the bank financing, you need to own 100%. In order to own 100%, you need to get to 2/3. And then once you get to 2/3, you can squeeze out the minorities. So your financing package is dependent on getting to 2/3. So what Fissimo did was very crafty. They said, we're willing to buy 100% of the company, and we have the capital to buy 100% of the company, but we're okay just owning a third. They already owned a little bit less than 5%, and their minimum acceptance threshold would get them to around 31, 32% of the company. That is effectively a blocking stake, because once you have a third, no one else can get to 2/3. And there are also various other things other than the squeeze out, major strategic moves that require supermajority. So once you've reached a third of a Japanese company's shareholding, you have what we would like to call negative control. You can't dictate things, but you can stop things from happening. So that's what they set their minimum acceptance threshold at, was something that would give them negative control and would give them an ability to block Tanaka-san's transaction. So that's very epic making that they did this, and they launched an outright hostile tender offer. They came in above the CEO and major shareholder. They came in notwithstanding the fact that this major shareholder owns such a large stake of the company. So in the end, they weren't successful in buying 100% of the company, but in clearing their minimum acceptance threshold and also completely derailing this underpriced MBO. So now you've got a situation where Tanaka-san and the founding family still own about 31, 32% of the company, and Ifissimo is sitting at the top table, shoulder to shoulder with the same shareholding. Now, I think they're perfectly happy having him continue to run the company. He's doing a good job. They just didn't want him to sort of steal it out from under the market. So yes, I agree with you. I think this is a major breakthrough transaction. Now, there have been a spate of MBOs launched over the last few months, many of which people think are underpriced. There's also another transaction, very large transaction, where Toyota is trying to take Tyco private. It's their forklift subsidiary. And a lot of people are very unhappy about the valuation in the offer that's been mooted. Now, that offer hasn't commenced, but they've kind of announced, we're intending to do this, and here's the price we're intending to do it at. And people are very upset about that. Now, this Soft 99 case was a very successful intervention by Ifissimo. I'd say the story is mixed on other situations. Some of them, we've seen shareholders effectively derail these deals. There's a deal for a company called Mandom, which is a male grooming company that was successfully derailed by Hibiki Path and Murakami. That got to the point, this was interesting, where the offer was still going. The target company's board withdrew its support for the offer, and then eventually they gave up. But I mean, it's pretty extraordinary to have the board, which endorsed the offer in the first place, withdraw its support afterwards. But then there's another one, Digital Holdings. Hakuhodo wanted to take control of Digital Holdings. Silver Cape, which is a pretty assertive Singapore and Hong Kong based family office, had a big stake and mooted the idea of launching a competing tender at a premium to the price that Hakuhodo was offering. What Hakuhodo did to get their deal done, Hakuhodo already owned a substantial chunk of this company. They dropped their minimum acceptance threshold. So originally, they were targeting the 2/3 so they could squeeze out the minorities and make this 100% subsidiary. But Hakuhodo is a giant company. Digital Holdings is a relatively small company. They don't need bank financing to complete the deal. So they dropped their minimum acceptance threshold to a level that would get them to 51%. So they would have control. And they were able to just squeak by on that basis. So I'd say it's still a mixed bag, and the market doesn't always win. But I'm really glad Ifissimo did what they did, and it is a signal of more things to come. I do think that we need some kind of further action, whether it's regulatory or otherwise, to improve the pricing mechanism for these MBOs, particularly where there's a related party involved. And there are guidelines from METI on this, which in theory should have solved the problem. But if we're looking at what's actually happening in the market, while the market for corporate control is evolving and becoming more important in Japan, this pricing mechanism aspect to it is still not working the way it really should. So it's, again, part of that emerging landscape here.
Are there any other activist case studies that's worth studying for people who are interested in Japan? We don't have to go much into the details, but for people to look them up as they listen to this.
I think the Fujitech situation is worth studying. And that was one of Oasis's hugely successful engagements, where there was a founding family that was running Fujitech. They only owned about 6%. Oasis came in, took a big stake. People were not happy with how management was running the company. Oasis actually dug up some malfeasance on the part of the founding family, made it public, and then was successful in ultimately removing the founding families from management, and then eventually in getting Fujitech's in the process of getting privatized. And if you look at the share price of Fujitech from where Oasis got involved to where it finally landed, shareholders have benefited tremendously. So there were a lot of interesting twists and turns. So it's a great story, but it's definitely something worth looking into and understanding. It's a great case study.
I'm Curious, as someone who's started his career in the US, working in law and then moving to Asia, where do you see the next few decades in the investing landscape in Japan? What are you most excited about? And this could also tie into your strategy and your focus. So it'd be great to understand your view of the future and where you think things are going.
Sure. Well, I think activism is here to stay in Japan. I think we're still in the early innings. I think that purely balance sheet driven activism is probably mid to late innings. I think the more M&A and business optimization, business portfolio optimization, privatization, all that stuff, we're in the first or second inning of that. So I think there's really a lot of interesting projects to do, and this will continue to be an important part of the Japanese capital markets and will continue to grow in importance over time. That's what I'm most excited about. And I think the Tokyo Stock Exchange will get its wish. I think they will get companies that are subscale will either delist or consolidate up to become bigger companies, and we'll get more large companies, and we'll get better companies for Japanese investors. And also we'll make these companies more competitive globally, because a lot of times you'll see a Japanese company that's got a great product or a great capability, but insufficient scale to really compete with the global players. And whether it's by making acquisitions overseas or by consolidating up the space in Japan, that's what it's going to take to get the heft to make those companies truly globally competitive. So I think it's a very exciting time. And I do think it's one of those opportunities where you can try to do well by doing good, that the changes that you're trying to get through corporate Japan are actually good for the companies, stakeholders, and also for the investors, many of whom are directly or indirectly Japanese individuals, whether it's through their pension fund or through their mutual fund, that this is something that's really a win-win. So I'm very excited about that.
We're seeing more success cases of activism in Japan. Notably, last year we saw Axiom Capital successfully replace the management of Tokyo Cosmos Electric. It feels like an exciting time. Could you expand a little bit more on why you think we're still in the early innings for activism in Japan?
I mean, I was checking when we were drafting our pitch book a few months ago what the average price book ratio was for topics listed companies. And it was, at the time, it was around 1.4, 1.5. I think it's now up to about 1.7. But compare that, the S&P, I think, is high fours, low fives. So even with the Tokyo market trading at historic highs, the valuation gap is still enormous. So yes, absolutely, there's a ton of opportunity. And I think it exists across the small cap space, which we play in, and people like Monden-san at Axiom play in, but even the larger cap space where people like Value Act, Elliott, and now Oasis, now they've gotten very large, are playing in. There are these kind of optimization challenges, capital allocation, improving business portfolios, exiting non-performing businesses, focusing management resources on their good and excellent core businesses. This exists across the entire market cap spectrum in Japanese companies. And so there's just a lot to do.
Thanks, Philip. To close, we're going to go totally off topic. Our final question is, what's a Japanese experience you wish more people knew about? This can be a specific place too.
Western food.
Yeah.
Everybody who comes to Japan, they want to eat sushi. They want to, and don't get me wrong, all that stuff is great. It's better here than anywhere else. But people, they don't think, I'm going to go to Japan, I'm going to have awesome Italian food or French food. But there's some of the best Western food in the world here in Japan. When you combine the Japanese dedication to doing things well with the extraordinarily high quality of the raw materials, the ingredients that are available here, whether it's the vegetables or fruits or meat or fish, because the Japanese consumer is so finicky, it's amazing. And a lot of people don't really think about that when they're getting ready to travel to Japan. But every time I've taken somebody to a Western restaurant, when they've allowed me to, they've said, wow, it's been a real eye opener. So that would be one thing that I would suggest people do. Get some Italian when you're in Japan.
I love it.
And I'd say just cruise around Tokyo and check out the different neighborhoods, because each neighborhood has its own flavor and feeling. At first, it may all kind of look the same, but if you go from, for example, Western Shinjuku, where City Hall is, and you have these forest of tall buildings, but it gets very quiet at night. You go to Shibuya, Scramble Square. You go to the Marunouchi area, which is the real business district. You go to Asakusa, the downtown area of Tokyo, Ueno. Each one of them has a very different flavor and vibe. And you really get a sense of the city just by cruising around and going these different areas. And it's very safe. And with Google Maps, it's easy to get around. So you can just wander and get lost and just soak it all in.
Do you have any asks for our audience? I'll mention Chronus-cap.com is your website.
Well, we're an emerging manager. We're a new fund. We're looking to raise capital. So if people are interested in learning more about our strategy and thinking about potentially collaborating with us, we'd be very excited to speak with people who are interested in that. And then if people are already invested in Japan and have stakes in different companies and just want to exchange views on them, we're certainly happy to take a look at their portfolio companies and have a think about how an activist might look at that situation.
Thank you so much, Philip. Really appreciate your time.
It's my pleasure. Thank you, guys.